Inflation fell to 2.8%, the slowest pace in more than 3 years, taking inflation well into the RBA's inflation target band, which is 2 to 3%. More importantly, the RBA was forecasting inflation to be at 3% by the end of 2024, and we are now well below that. As such, it is likely the RBA will have to revise down their inflation forecast in the November statement on monetary policy. Now, that is not all good news, as we know that the government cost of living rebates had a significant impact on the headline measure of inflation. The good news is that core inflation, which trims out the extreme price moves from both the high and low sides, excludes the impacts of these rebates. This measure printed 3.5% in the year to September, down from 4% in June. More importantly, the momentum in inflation, which we measure as a 6-month change in prices, annualized so we compare it to the annual rate of inflation, fell from 3.8 to 3.3. Given that our year-end forecast for the trim mean inflation is 3.3%, we are well on the path to do better than that. Looking into the details, the September quarter CPI gained just 0.2% in the quarter. As noted, this was due to the cost of living assistance, which saw housing go from making the largest contribution to inflation in the June quarter, rising 1.1%, to making the small negative due to falling electricity. Electricity fell 17.3% in the September quarter. To give you some idea of the magnitude of the variation in the rebates between the capital cities, electricity fell 93% in Brisbane. The Queensland Government provided an additional $1,000 lump sum on top of the Commonwealth's rebate, which is $75 a quarter. It was down 56% in Perth, but fell only 5% in Melbourne and down a more modest 2% in Sydney. We should also note that the increase in dwellings, up 1%, and rents, a larger 1.6% rise in the quarter, were softer than they thought they would be, suggesting housing may not be as inflationary as we thought. The monthly CPI indicator for the last month of each quarter is released on the same day as the quarterly CPI, so it's often lost in all the excitement generated by its older sibling. While it's not a perfect measure, it is still a very good update on the monthly momentum in inflation, and the September update was very promising, reporting inflation at 2.1%. If you exclude the volatile items, monthly inflation was 2.7%, still quite a drop from the 3.7% reported in June. Meanwhile, the monthly trim mean measure of inflation was 3.2%, and while this is still just above the RBA's target band, it is below the 3.5% reported in the quarterly trim mean, and well down on the June pace of 4.1%. So, what does this all mean? It is true that the main force driving headline inflation below the 3% were the cost of living rebates, and as such, the RBA will look through this drop. It is also true that services inflation remains sticky, with market services, excluding those volatile components, coming in at 4.5% in the monthly measure. However, if you exclude those very volatile holidays components, something the RBA does tend to do, you'll find it's a much softer 2.7%, highlighting that moderation. And if you dive into the monthly data, as our chief economist Lucy Ellis noted, that the September quarter CPI confirmed that disinflation, a fancy echo word for describing prices going up at a slower pace than they were, remains on track. As such, with supply side concerns easing, that is, a labour market softening and unemployment drifting higher, wage increases are likely to be less than what the RBA is expecting, meaning rate cuts from February still seems the most likely path.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.